National income is the total money value of all goods and services produced by a country's people over 1 year. This includes everything made within the country and by its citizens living abroad. National income helps us measure economic growth. If it goes up, it often means more jobs, higher incomes, and a better standard of living. It is important for governments because it shows the overall health of the economy. Using national income data, governments can create plans to support economic growth and improve people's quality of life. What makes up national income? National income consists of all the money earned from various sources such as wages, interest, rent, and profits. These earnings come from four main economic activities, such as labor, which includes wages and salaries earned by workers for their jobs. Next is capital. This refers to income generated from investments, such as interest earned on savings or returns from stocks and bonds. Next is land. This encompasses rent paid for the use of land and natural resources. Lastly, entrepreneurship. This includes profits made by business owners who take risks to create and brand their businesses. Now, let's move on to the types of national income. The first type that we have is the gross domestic product. GDP is the total value of all goods and services produced within a country's borders over the course of a year, encompassing everything generated domestically, regardless of whether it is produced by local or foreign companies operating within the country. Why is it important? GDP tells us about the economic activity happening within the country. When GDP grows, it usually means the economy is doing well, with more production, jobs, and spending. GDP is made up of consumption, investment, government spending, and net exports. Now let's consider this simple example. Imagine a country's total spending on goods and services is broken down as follows: 500 million for consumption, 200 million for investment, 250 million for government spending, and 50 million for net exports. Given that example, all we have to do is to add all those numbers to find the GDP, which is 1 billion pesos. Next, we have the gross national product. GNP is the total value of goods and services produced by a country's residents both inside and outside its borders. GNP includes the income earned by a country's citizens working abroad and excludes income earned by foreigners working within the country. GNP is important because it gives a broader view of the economic contributions of a country's citizens, whether they're working at home or overseas. The difference of GDP to GNP is, while GDP focuses on where the production happens, which is within the country's borders only, GNP focuses on who is working or producing, regardless of the location. Now let's consider this simple example. If a country has a GDP of 500 million, its citizens earn an additional 30 million from overseas jobs, and foreigners working in the country earn 10 million, then the GNP would be calculated as follows: 500 million plus 30 million minus 10 million is equals to 520 million. Now let's move on to the other types of national income. We have the net national product. NNP is GNP minus depreciation. Depreciation accounts for the decrease in value of assets over time due to wear and tear. For example, we have machinery, equipment, or infrastructure. Next is the national income. National income represents the total income earned by all the factors of production, which is the land, labor, capital, and entrepreneurship within a country. It is sometimes called as national income at factor cost because it's the income before adding taxes or subsidies. Next, we have the personal income. It is the total money that individuals and households earn before taxes. It includes wages, salaries, dividends, and money received from government programs like pensions or unemployment benefits. Personal income shows the overall income available to people before they pay taxes, giving an idea of the earnings from various sources. And if we have personal income, we have the disposable income. It is the amount of money that individuals have left after paying taxes. This is the income available for spending on essential needs such as food, housing, and other necessities, as well as for savings or discretionary spending. The purpose of disposable income is it indicates the financial resources individuals can use to support their living standards and lifestyle choices after fulfilling their tax obligations. And lastly, we have the per capita income. Per capita income is the average income per person in a country calculated by dividing the national income by the population. Its purpose is it helps compare the standard of living between countries or regions. Higher per capita income usually indicates a higher average standard of living.
Income approach. This method focuses on production and adds up all types of income, such as rent, wages, salaries, profits, and interest. However, it doesn't include transfer payments, illegal money, or the sale of second-hand goods. The income approach, sometimes referred to as the income capitalization approach, is a type of real estate appraisal method that allows investor to estimate the value of a property based on the income the property generates. It is used by taking the net operating income of the rent collected and dividing it by the capitalization rate. For example, a property with a net operating income of $700,000 and a chosen capitalization rate of 8% is worth $8.75 million. Expenditure approach. This method measures the total domestic expenditure of an economy, which includes consumption and investment expenditures. Expenditures approach is a method of calculating gross domestic production by summing the amount spent on final goods and services within an economy during a particular period, usually a year. An example of an expenditure approach would be to include in the GDP when you purchase the new iPhone 14. Product approach. This method divides the economy into industry sectors such as agriculture, fishing, and transport, and then adds up the total output of all companies in the economy. The product approach can refer to a number of different things, including a work organization method, a writing-teaching method, and a sales approach. First is work organization method. The product approach is a method for developing products that meet customers' needs. Writing-teaching method. The product approach is a traditional writing-teaching method that involves student copying model text. The approach focuses on grammar, cohesive devices, and a specific type of language. Sales approach. The product approach in sales involves providing prospects with a sample or free trial to evaluate the product. It can also take the form of a product demonstration. Next is challenges in accurate measurement of national income. The first challenges that we have here is underground economy. Black market and illegal activities are not included in GDP calculations because it is difficult to accurately measure them. Second is double counting. It can be difficult to distinguish between intermediate and final goods, as the same item can be both in some situations. For example, sugarcane is both an intermediate and final product in juice manufacturing. Next is depreciation. GDP accounts for investment in new capital, but it doesn't subtract the lost value of depreciated capital. This can lead to GDP overstates economic activity in countries with rapidly depreciating capital. Next is environmental degradation. National income accounts can behave in ways that are counter to environmental degradation and changes in natural resources. For example, environmental destruction and resources depletion may be allowed to happen to boost GDP. The last is value of services and goods. It can be difficult to calculate the value of services that are free or goods that are used for self-consumption. Importance of national income. First is economic growth. National income accounting measures a country's economic activity and growth. Policy making. The data helps policymakers create economic policies, set tax rates, and adjust monetary policy. International comparison. National income accounting allows countries to compare their economic performance. And last is standard of living. National income accounting helps gauge a country's standard of living.